History doesn't repeat, but it does rhyme. And right now, Cathie Wood says we're standing in 1995 all over again, the moment just before the internet stopped being a toy and became the backbone of the global economy. Between 1995 and 1999, markets witnessed the most explosive burst of growth in modern history. Amazon, Google, eBay. Entire trillion-dollar industries were born in that short window. Investors who saw it early made fortunes. Those who dismissed it got left behind. Cathie's message: we're at the same kind of inflection point today, but this time, it's not dial-up modems and dot-coms. It's AI, it's blockchain, and most importantly, it's Bitcoin and crypto at the very core. But before we dive in, if you're enjoying these videos, check out our free daily email, Crypto Nutshell. Tens of thousands of investors already read it every morning. In just 5 minutes, you'll get the biggest stories, the sharpest predictions, and the on-chain data that actually matters. It's fast, it's free, and it keeps you one step ahead. Hit the first link in the description and subscribe today. Now, let's get back into the video.
Brett Winton, our chief futurist, featured a chart today during our brainstorm, which compared what's going on now with ChatGPT and other LLMs, chatbots in the consumer space relative to uptake in the internet days on PCs. What we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999 was the biggest burst in the growth sector of the market in history. It went too far, too much capital chasing too few opportunities too soon. And so it ended badly. But we're just at the beginning of this, and we're pretty excited about it. And we think this is much more on the consumer side.
Cathie's internet analogy isn't just a throwaway line. It's a framework for understanding how fast innovation cycles compound. Back then, the internet went from niche hobby to mainstream utility in just 4 years. It happened faster than anyone predicted. And while the dot-com bubble eventually burst, the infrastructure survived and went on to become the foundation of trillion-dollar companies. That's the parallel today. We're entering the same early stage, but this time with multiple innovation platforms converging at once. AI transforming productivity, robotics reshaping manufacturing, energy storage redefining power, and blockchain reconstructing money itself. The rails are stronger, the adoption curves are steeper. And when those forces collide, markets don't crawl higher slowly, they accelerate vertically.
Just keeping our eye on this target, 3% deficit as a percent of GDP. You can see we've seen a small improvement. Tariffs are beginning to impact the deficit or improve the deficit. They're running somewhere between a $400 and $500 billion rate. That's an annual rate. And that would get the deficit over 1 year to roughly 4.7, 4.8%. So continued progress we expect. This is a lightning rod issue for the markets, and it's because the interest level is so high already, higher, as many people know, than the defense budget, that it seems that that is going to be overwhelming. We won't be able to overcome this because just paying that interest bill is such a drain. We are focused on it as well, but focused on ways to get it down to 3%. Tariffs will pick away at it. But we think much more important, besides the Doge cutbacks, which are still impacting government spending with government layoffs featured prominently in the unemployment report. So those have a long way to go, actually. And then the other thing that we're focused on is real GDP growth. And we believe, as we've said many times before, that real GDP growth, starting later this year into 26, in time for the midterm elections, we think it's going to surprise on the high side of expectations, significantly on the high side of expectations. And so we think that is going to be probably the biggest answer to the deficit falling as a percent of GDP. This was also the answer in the Reagan years, moving into the Clinton years. There we ended with a surplus. And we do expect a surplus, maybe not in the next 3 years, but again, just like in the Reagan years, it takes time to turn the profligate spending around and correct for excesses. So within the next 4 to 5 years, we would not be surprised to see a surplus. Again, very dependent on real GDP growth. And as we've talked about many times in the past, we do believe that we're ready for prime time for all of the innovation platforms around which we have centered our research and investing for years. So robotics, energy storage, AI, multi-omic sequencing in the life science space, and blockchain technology. All of them are being catalyzed by AI. Of course, AI can't catalyze itself, but you know what I mean. All of the other platforms are being catalyzed, and I think the speed of change is going to be pretty shocking over the next few years.
Most analysts today obsess over deficits as if they're an immovable weight that guarantees stagnation. Cathie flips that on its head. Growth itself, she argues, is the answer, and innovation is what delivers it. In her framework, real GDP doesn't stay capped at 1 to 2% forever. When productivity surges, growth surprises to the upside. We've seen this before. In the 1980s and 90s, the US deficit flipped into a surplus because new technologies, personal computers, semiconductors, the early internet, drove growth far faster than expected. Today, the same setup is forming. Only now, the technologies are bigger. AI isn't just a tool, it's a force multiplier. Robotics and automation are solving demographic gaps. Energy storage and nuclear are breaking power bottlenecks. And blockchain is creating entirely new markets that didn't exist before. Cathie ties it all back to crypto. If innovation drives productivity and productivity drives growth, then what looks unsustainable on paper suddenly flips into something more optimistic. In that world, Bitcoin isn't a side bet. It's the digital foundation holding the whole system together.
I've just taken a trip through Asia, and it is clear that the only focus in Asia is on tariffs and those headlines, but they're not focused on the massive deregulation that's taking place in the United States. Crypto, we're seeing big changes there, of course, legislatively, and also in the court system and in the regulatory system. So there we're seeing the first executive order, I think, that President Trump rescinded, this was a Biden executive order, was on AI to free up innovation in that space. Nuclear energy, all kinds of energy to solve the power needs associated with AI and data centers. Huge deregulation, huge. Now that is slower moving by nature, but on our site, you will see how much regulation has held back nuclear energy here in the United States and in Japan since the 70s. And we're rectifying this 50-year problem now at warp speed, at least for that sector. And just to give you a sense, China is constructing today 28 large-scale nuclear reactors. In the US, we are not constructing one. We have been so constrained by regulation. And the antidote to that has been small modular reactors, And those are proceeding apace. Again, regulation takes time, but again, proceeding apace. And we think from the largest to the micro nuclear reactors, we're moving into a nuclear age. When Brett Winton and I were at our last firm, Brett and his team authored a book, a big black book, on nuclear and how safe and sustainable it was and is. And then unfortunately, Fukushima happened in Japan and unraveled nuclear for yet another decade, more than a decade. Again, the regulators had the upper hand around the world. And now we're back, and so that's good. All of these are going to feed economic growth.
But it's not just growth. The rules themselves are changing, and that changes everything. For decades, nuclear, crypto, and AI were throttled by regulation. Now, those walls are being torn down. In AI, restrictive orders have been rescinded, freeing up development. In nuclear, the US is finally clearing the path for modular reactors after half a century of stagnation. And in crypto, the courts and Congress are opening the floodgates for institutional capital. This isn't a side story, it's a catalyst. Cheaper energy unlocks AI. AI drives demand for secure rails. Blockchain provides the trust layer. Each breakthrough amplifies the next. And when regulation falls, innovation doesn't crawl forward, it sprints. For crypto investors, the message is clear. The same forces clearing the way for AI are clearing the way for blockchain. The pipes are widening. The capital is about to flow.
Productivity is going to be very important in terms of not only holding inflation down, but driving it down. And we've been saying this for quite some time. Inflation may seem stuck in the 2 to 3% range right now, and tariffs are aggravating that, of course. But we would not be surprised to see inflation drop in the years ahead to zero or even negative. Because we think the innovation that's taking place now is going to be pretty explosive. And technologically enabled innovation is deflationary by nature. It follows learning curves, which are expressed in cost declines. It's all about efficiency. And so we think that's going to be a big part of the story.
Here's the collision that defines the decade. On one side, deflationary innovation, AI, robotics, and blockchain push costs down, increase efficiency, and multiply output. On the other, governments buried under 400% of GDP in debt. They can't grow out of it. They can't default without chaos. That leaves one option: monetary debasement. Cathie's argument is simple. Innovation is deflationary. Debt forces liquidity expansion, which means central banks will always err toward easing, not tightening. For investors, the signal is clear. In a world where productivity gains collide with constant liquidity injections, assets that sit at the intersection don't just outperform, they dominate, and Bitcoin is sitting right there, benefiting from tech adoption on one side and from monetary debasement on the other. It's the purest expression of this macro equation.
This last chart, Bitcoin to gold, so has not broken its uptrend, but has had a setback in here as Bitcoin has settled down and gold has continued to go up. Our bet is that Bitcoin will continue this uptrend over time, but we are paying attention, trying to understand what is gold telegraphing relative to Bitcoin.
This is where Cathie draws her boldest line. For decades, gold was a hedge, but gold doesn't innovate. It doesn't earn yield. It doesn't plug into AI, DEFI, or tokenized markets. Crypto does. Her team has tracked the Bitcoin to gold ratio for years. Despite volatility, the long-term uptrend is intact. Even as gold pushes to new highs, Bitcoin keeps printing higher lows. Think about the implication. If gold could rise 10 times in the 1970s as inflation surged, what happens to Bitcoin? A programmable, globally liquid, provably scarce asset in a world of 8% structural debasement layered on top of exponential innovation? Cathie sees Bitcoin not just as an alternative hedge, but as the new standard. Gold is defensive capital. Bitcoin is offensive capital. And in this regime, offense wins.
Compared what's going on now with ChatGPT and other LLMs, chatbots in the consumer space relative to uptake in the internet days on PCs. What we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999.
Cathie closes the loop by returning to 1995. We're not in the late stages of a bubble. We're in the opening act of a supercycle. The internet minted trillion-dollar companies. AI and blockchain will do the same, but at even greater scale. In 1995, most investors dismissed the internet as a fad. Today, the same skepticism surrounds crypto. But adoption curves don't lie. Blockchain is tracking faster than the internet did in its early years. That's why Cathie says this isn't the end of a cycle. It's the beginning of one. And Bitcoin, sitting at the center, is positioned to be the single best performing asset of the decade. So if you found this breakdown useful, hit that subscribe button right now. It helps the channel grow. And make sure you don't miss the signals that matter before the next supercycle takes off.